Welcome to Freightonomics, the podcast / show that we discuss the freight market along with that economic output. I'm Zach Strickland.
I am Anthony Smith.
As usual, and of course, we now have a sponsor. Thank you, Amazon Freight. After years of fine-tuning their technology, working with trusted carrier partners, and leveraging infrastructure to optimize their logistics, Amazon Freight is now offering shippers of all sizes the ability to tap into their network to optimize your business. Shipping full truckloads with Amazon Freight means reliable capacity, competitive rates, and instant quotes. If you're looking to ship or ready to haul, visit freight.amazon.com to get started. And with that, let us get this show started. Anthony Smith, we have your good friend, my good friend now. I feel like we're friends now.
He's my friend first.
He was your friend first, but I feel like, we were talking a little bit before the show about the weather and the snowstorm out in Denver, Colorado. And well, he's not in Denver, but close enough.
Yeah.
And I feel like we have rapport now. I feel like we've got that tightness.
Z1 and Z2.
Yeah, I feel like we're friends now. But he's going to come on a little bit later and talk to us about the LMI, the Logistics Managers Index, which of course he has a lot of influence in building and creating something that is from my perspective, has been a pretty invaluable resource.
Highly underrated, in my opinion. I mean, it's like everyone gets of course, the PMI is huge. Everyone hears about the PMI. But the LMI, if you're in freight, is directly related and directly correlated. And it's broken out into different components. And I'm sure Zac Rogers will tell us more about that. But that's just the thing. It's like warehousing, inventory levels, trucking capacity, transportation prices. And it's just
another way to slice our complex economy and kind of position it towards a more transportation, logistics-centric view. The PMI, of course, is something that the Institute of Supply Chain Management creates that, and they are that's very focused on manufacturing and new orders and building things. It does have an impact to transportation, but it's not as direct. We're talking about transportation, warehouse, as you said. Warehouse to me is one of the most underreported things that we measure in this country, especially nowadays when you have supply chains that are built based on how quickly can they get to the end user. Is there a middle point? There's all sorts of different network optimization things that you can do by repositioning your warehouses and your inventory.
Yeah.
And looking at these inventory levels at the different points along the supply chain can really give you a lot of insight into what part of the process we're in. We've been talking about this story since COVID really had its, starting of its recovery. A lot of people, including myself, couldn't believe that the freight market would recover to the extent and the speed with which it appears to have done. We're looking at spot rates, of course, hitting all-time highs in a lot of areas. Spot rates in individual lanes, of course, just shattering that $3 a mile mark in a lot of areas right now. And a lot of that is in front of demand.
Yeah.
Like the consumer wasn't online totally, or at least in the same way that they were in, 2019. We still had a divergence of demand going to things like electronics. We've talked about it before, that athleisure, and things like that there's all these behavioral shifts, and they have enough money here early on in the process to where they can go and buy, that $20 Lululemon. Is there such thing as a $20 Lululemon?
I mean, you might. I don't know. I want to say you can get a headband, but I don't even think you can get a headband for $20 at Lululemon.
Well, they were buying them up because they were sitting in the house with not a lot to do.
Yeah.
Home goods, home supplies, remodeling. Home Depot, Lowe's, of course, showing record beats. Throughout what has been a very depressing. So it's a very uneven market. It's not just simply reporting a number in aggregate and saying, the economy's up.
Yeah.
If we were to rely on GDP all the time and to look at transportation,
it's not a good representation.
Yeah.
I mean, it's completely disconnected, and it's just like you said, like we have to look at all different aspects, all different perspectives. And I think one of the other ones that people are finally getting out of their heads is looking at the stock market for an indication of what's going on in the economy, because this thing's been rallying, especially like when we saw skyrocketing jobless claims. And it's just like, okay, glad everyone can see that these two things are not connected directly.
Yeah.
A lot of it's going to be speculation. Sometimes it's going to be moving in the same direction. A lot of times it's not going to be moving in the same direction. And we have to look at all different perspectives. But yeah, looking at GDP, not going to be the best representation of freight overall.
Not at all. And it's also going to be very lagged and distorted because you have services involved there, which have nothing to do with freight. We have become a very service economy. We don't manufacture a lot of stuff here. We import most of it.
We import a lot. And the stuff we do manufacture, a lot of it now, it's automated.
Yeah.
I mean, a good part of it's automated. And I think, especially with COVID, we're going to see a lot more automation, a lot more socially distant, aware manufacturing facilities potentially, as we see more capital and less labor on that kind of barometer there. And so I think that's going to be much of the future. And I mean, when we saw the latest PMI, the latest Purchasing Managers Index, we're seeing increasing rates for the production. We're seeing increasing rates for the new orders. Of course, 21-month high doesn't mean that it's at a 20-month high overall for manufacturing, but it does mean that it's improving on a month-to-month basis. And the thing that's still below 50 is that employment area. And I think the latest was 44, so it's kind of getting a little bit higher. It's less bad.
Less bad, yeah.
But it's still below
statement.
50, still contracting. And I think that's going to be a pain point for manufacturing, although it is recovering at a pretty decent clip. I think we were talking manufacturing and construction being the two hot points that could really rebound quickly and help support freight movements, of course.
Yeah, I think we have, unfairly kind of, as an industry, attributed too much freight movement to domestic manufacturing. It's just simply not a thing that really drives it. I mean, importing, think about it. If you're a company and it's cheap, way cheaper to go and hire somebody, 3,000 miles away to build your products and then bring them in, we're really expensive. We're really expensive to make things. So therefore, you have so much offshoring. Everybody's talking about nearshoring after the COVID thing and what that may do to that side of things. And that may actually, bring that manufacturing component a little bit closer to home. But you're still talking like a long time away. A lot of the investment, something you can glean from the stock market is, where's all that investment capital going?
Yeah.
A lot of it's going into technology.
Yeah.
Look at that NASDAQ just shooting up all the time.
Right.
Had a bit of a hiccup over the last few days, but, it's still, technology is going to drive the quality of life higher. That's where we're going to get that automation in the manufacturing and all that done. But that will be a deeper dive for another day. Anthony.
Maybe we can get Seth Holm on here with that.
Seth Holm would be great. Former hedge fund
for you.
Manager. That'd be a great person to have on and discuss some of those nuances and why the stock market can be so disconnected. But there's also information to be gleaned from that. It's not just simply all these quants or quantitative traders sitting up there, refining their algorithm every day, although that's most of it.
Yeah.
But they do have some logic built in there that's not simply market psychology anymore. But before we bring Zac Rogers on here in a little bit, it's a special week for freight and the freight market. And a lot of people every year, and this doesn't have as much weight as it had in 2019, but it is Road Check Week, the second one of the year. This one is focusing on driver requirements. So traditionally what this means is you have a lot of drivers, avoiding areas, avoiding being on the road for certain periods of time, avoiding, all these different things because they don't want to get pulled over because they have roughly a third of the drivers get put out of service every year. Road Check Week, the ones that get inspected. There's roughly, I think, 3,000 as Clarissa Hawes, who wrote the article on FreightWaves.com. Please check it out. The title of the article is, Are You Ready? CBSA's International Road Check Gets Rolling. And it's a 72-hour blitz where they're going to be checking ELDs, basic, is the driver impaired in any way? Are they keeping all their logs accurately? Are there any signs, documentation? Everything needs to be in order, proper licensing, that type of stuff. Just basic, functional requirements of operating a Class 8 vehicle. And they're going to be doing that for the next 72 hours. Again, this could further exacerbate what has already been a super tight market.
Yeah.
It's kind of interesting to me that they picked, they delayed this from May. It was originally, this part of it was scheduled for late May. And it's interesting to me that they do this around holidays. They normally do this first week of June, right after Memorial Day, when capacity is already kind of tight.
Yeah.
It's almost like take a vacation, drivers, make the market tighter.
Yeah.
And they, this is right after Labor Day, holiday week. So it's almost like encouraging drivers to take the week off. But
yeah, because if you're a driver, you don't want to be stuck out there, right? Like, even if everything's on the up and up,
yeah,
I want to know, why risk it? Like, what if I miss something on accident and now it's just a simple mistake and now inconvenient.
Yeah, no. And I mean, and they're doing this in the name of safety. So
Yeah.
it's obviously not necessarily a bad thing. They want to make sure everybody's compliant and operating a vehicle in the most safe manner possible, in the safest manner possible. And that's a good thing. And they do need to do that, but they probably should do it all the time when they can. But again, this generates awareness. So hopefully all the drivers out there are a little extra safe and on their game this week. And if they are, it will be worth their time, and because they're going to be making
rates.
They're going to be making a good bit of money.
Yeah.
Tender rejection rates continue to increase this week. Normally we see, this kind of hump in the tender rejection rate right around these holidays where it increases in front of the holiday and then drops off right afterwards. It's almost like a mound effect, if you will, because again, you've got home times to be concerned about if you're a carrier that really, they put a box around their geography, so they can only be like, say they're domiciled in Nashville, Tennessee. They basically say, we want to make sure that you're within 1 day of your house for the weekend. So they're not going to give them another load that pulls them out of that range. So that means that that's reduced optionality, reduced, capacity in the networks out there for these shippers. And again, a lot of shippers like to get things out before a holiday.
Right.
So that tends to put a little bit more pressure on rates. But this year, tender rejection rates are already through the roof, over 26% today for the first time all year. And, since 2018, we have not been in this range before. So something we're going to talk about with Dr. Rogers here in a bit is that transportation capacity. And we are still continuing to see it just rise.
A lot of consumer goods too. I mean, we had Chris Bryant, my trucking cousin, on the show not too long ago, and he was talking about stuff he's been hauling, and a lot of it's been on the consumer-facing sides. I mean, I think he was hauling pools last time we spoke to him.
Pools, yes. Yes, the flatbed operator, of course, gets to haul all sorts of fun stuff.
Yeah. And so it's just crazy to see that amount of consumer activity continuing. In spite of all of the reduced jobless claims benefits and some, even though we've had employment rates drop down unexpectedly, but not this much, to I think right around the mid 8% point.
So you're bringing up a really good point. I think we should hit on this real fast while we have some time. This idea that the unemployment rate, this is something that I debated with Craig Fuller back a few months ago. That unemployment rate made me so nervous that I could not expect demand to come back online as fast as it did. However, the stimulus, of course, helped boost that. But there's also this inequity in that unemployment report. And it's heavily weighted towards, your service industry people. Can you break that down a little bit for us? Tell us, really what that unemployment rate means at this point in time. I don't expect you to have, I'm kind of springing this question on you out of nowhere, but I think it is important to know that 8% unemployment or 9.6% unemployment rate it's not all the same. It's not the same unemployment rate that you would expect during a recession.
Right.
It's a lot of hourly wage, lower income people that are no longer, in the space, and they're getting, they still got a lot of money through July.
Right.
So they might be coming, that might be coming due here in the next few months.
Yeah.
Thoughts?
Yeah. So as you mentioned, I mean, a lot of it's going to be kind of weighted to certain industries.
Mm-hmm.
And when we're looking at the unemployment rate, of course, there's that dichotomy of, okay, are we talking about people currently looking for work or discouraged workers? There's that whole other topic that's for another time, neither here nor there right now, but looking at the current unemployment rate, and we see that, government has been a pretty substantial industry right now with new job openings in the most recent month, retail trade getting active, transportation and warehousing, of course, professional and business services, educational and health services. So we are seeing a lot of service-heavy based employment opportunities that are kind of coming back online right now,
Yeah.
which is encouraging. And of course, this unemployment has greatly surpassed where we were during the Great Recession in 08, 09. But we're starting to see that quickly come back down. And I think that's one of the things that you mentioned early on in the pandemic was like when we see these sudden shocks and sudden jolts, we'll start to see these subsiding when we have natural disasters. And treating this as a natural disaster, I think, was definitely a spot-on call. But when we're looking at not just unemployment rates, but jobless claims, that's coming down. That's below 1 million once again in the latest report that was released last Thursday. But it should be noted that number now has been altered and is now being analyzed a little bit differently on a seasonally seasonally adjusted basis. And so some reports are saying that it's a little bit artificially lower and they're expecting it to rise a little bit more in the coming weeks potentially, but it is below 1 million and the historic numbers aren't getting adjusted as well. So you might just having that smooth comparison, but this is supposed to be a more accurate representation of the unemployment sector or
unemployment in general.
Yeah. But when we're looking at overall unemployment, it just has been a complete, I think, although there is still a long way to go, there is a lot of positive news with the jobless rates that's in the U.S. right now.
Yeah, aren't they tracking now permanent job losses versus temporary job losses? And there is a concern moving forward about, the permanent job losses appear to be they're going to be the ones that are going to be sticky.
Yeah.
You know what I'm saying? Like, yeah, a lot of that unemployment number was kind of fluff. It was like, you know what, you can get paid to go sit at home. We'll take the break as a company from having to pay you for a bit. The government's going to give you your paycheck for the time being. But in that number, which is, very difficult to see, as an aggregate, we're not really sure how much of those aren't coming back, say, in January or when, we are allowed to go fully, back to work.
Right. Yeah. And I think that's been one of the really big, talking points that wasn't really expected early on. A lot of people expected when jobs come back, it'll be just business as usual, but there is a substantial amount of permanent job loss that hasn't been expected, I think, early on as we see this kind of progress, because I think certain ideas are being adopted, certain, ways of life, work-life balance of being adopted. And so when we're looking at that, that's going to eliminate a lot of potential industries altogether. And I mean, one of the ones that's going to be, I always talk about, that's going to be impacted the hardest potentially, of course, is flight. Flying throughout the country, pilots. I'm thinking these are professionally trained individuals, but we're not flying as much. And that's going to be a hard industry to pivot out of when you're so specialized.
The airlines, of course, United's done a great job, reportedly, of transitioning into that, cargo-centric model, which they already had a decent model for, stronger than either Delta, Southwest, and because they have the larger jets set up for that type of freight movement. But yeah, a lot of those people aren't going to get to come back to the airline industry anytime soon, because even as we kind of relax our standards, the social distancing, et cetera, there's still a lot of people that have figured out a way to be without that travel.
Yeah.
For the time being. We've all adapted, our businesses around not being able to fly to certain areas. So now we have all this technology, the Zoom calls and the Google Meets and all these other video conferencing things that have actually kind of almost seamlessly replaced a lot of that need.
Yeah.
So it doesn't mean that those, it's a net negative, because a lot of those jobs are now going to go to technology.
Yeah.
Not that those workers are able to transition into technology, but it's going to create jobs in another space. So one's loss is going to be another's gain at some point.
Definitely. Especially when we're looking at, that supply and demand of adequate labor in certain industries. And looking at that, I'm definitely a little bit, I'm anxious, I should say, for the first quarter of 2021. I think that's going to be
that's kind of my mark
sobering
too.
moment.
I think I had 2 points, Mark. When I was debating Craig the second time, one of my marks was I thought October we would see the first sign of, the market kind of softening a little bit or loosening. We'd see some sort of, sign of the industry kind of, or the demand really kind of loosening up. And if we got through that, then I was like, all right, well, January is going to be the for sure. Now, if we see some sustainability throughout January, we know we're in a different world order.
Right. And speaking of that, I mean, we should probably get on to having our special guest, Zac Rogers,
is Zac Rogers available?
He is available, but before we do, I'm so very thankful about this show, about people watching, and I'm also thankful for our sponsor. Thanks to our sponsor, Amazon Freight. After years of fine-tuning their technology, working with trusted carriers, partners, and leveraging infrastructure to optimize their logistics, Amazon Freight is now offering shippers of all sizes to tap into their network to optimize your business. Shipping full truckloads with Amazon Freight means reliable capacity, competitive rates, and instant quotes. If you're looking to ship or ready to haul, visit freight.amazon.com to get started.
And well said. And Zac Rogers, welcome to the show.
Hey, how's it going? I'm happy to be calling in from the end of the world, where the temperature has dropped 65 degrees in the last 48 hours, and we've gone from fire to ice. But yeah, it's exciting times, and look at you guys with your sponsors. Look at, I knew this was the number one freight economics podcast.
This is the number one freight economics podcast, and I was going to say in the country, but in the world.
In the world.
I'm
going to be that bold.
Worldwide.
Hot take. So, Dr. Rogers, we've got about 8.5 minutes left to discuss the LMI results. So break it down for us. Give us the high points of the LMI.
Perfect. No, that's good. We never go long, so 8.5 is perfect. So so basically, what we saw this month is a really big jump. So our overall index score came in at a 66, highest we've seen since October of 2018. All right, so these are, and we remember Q4 2018 was pretty good times, and so our growth rate's coming back around that way. Yeah, and it's driven by transportation. All right, so our transportation price growth came in at 84, and just so we all remember, it was at 37 in April, kind of when everything started. So we're up 46 points since really the dip happened in the pandemic.
And this is also based on the number 50, right? So that's a pretty high number.
Yeah. So thanks for reminding all the new viewers. Anything above 50 means growth. Anything below 50 means contraction. And so to have an 83 is essentially, an almost unprecedented level of growth. And so it's way up there. And at the same time, capacity is a 30. And so it's basically impossible to find a truck. And the ones that you do tend to be really expensive. And I think that this really informs us a little bit when we think about, and you guys were kind of mentioning it at the top of the show, why are we seeing this freight come back, sort of come back at a disproportionate level to the rest of the economy, right? Because like you said, we got a lot of people unemployed. There's a lot of businesses that aren't really up to full speed. Yet, we're trucking like it's June of 2018. So what's going on? Well, basically, if you look at how COVID has changed the way we do things, trucks have never been more important. Okay. So again, if I'm a freight person, this is great because look at retail in Q2 this year. 16.1% of retail in Q2 is e-commerce. Compare that to Q2 in 2019, it was 10.8. So 10 to 16, that doesn't seem like a big jump until you think that's a 50% increase. So e-commerce as a percentage of total retail is up 50% year over year. Well, as we know, e-commerce is much more sort of logistics intensive because we have all of the last mile stuff. So not only are we having more trucks on the road, we're using more warehouse space. We're holding more inventory closer to the customer. And inventory held closer to the customer is more expensive. You know that I used to work for your new sponsor, Amazon. And when I did, I was out in the middle of the desert in rural Nevada. I used to drive by cows sometimes, and not like cows on the side of the road, like cows in the road, because you're just out in the middle of nowhere. That's not the type of inventory we're building up. Not out in the middle of nowhere. It's, in downtown Seattle or, 20 minutes away from a population center. That's the inventory that's increasing now. And so we're seeing a bump up in warehouse prices because of this increased reliance on e-commerce. So transportation's up, warehousing up, because everything's getting closer and closer. So when we say 16 versus 10, what that means is even if the economy's not recovering that quickly, because e-commerce and logistics services are so much more important to the recovery we do have, we're seeing this bump up in freight, and really sort of logistics services are leading the way in terms of the recovery. And I think we'll continue to see them recover and go up, even if the economy stays relatively flat.
Yeah, I think you're making a really solid point in that whole end user repositioning inventory closer to the endpoint, final destination, having a huge impact to what we're seeing in the industry right now. Now, we are coming up on the fourth quarter here, which of course is the name of the game is e-commerce here in the fourth quarter, and expectations are that it's going to have an exacerbated effect on the rest of the industry in the space. And considering that tender rejection rates, capacity, everything's getting tighter, volumes have not slacked at this point so far. What do you think that's going to do? I mean, do you expect that this fourth quarter to be one of the most robust that we've seen?
I think so in terms of the freight market. I mean, overall, consumer spending could go down. As you guys mentioned, the stimulus stuff has sort of been discontinued, and unemployment right now. I mean, it's interesting. The number of unemployed people went down last week, and then average wages went up, meaning that the people who are still unemployed tend to be in those sort of lower income brackets, as you guys mentioned. So overall spending might actually be down in Q4, but logistics spending, I would say, is going to be up because, again, there's going to be more trucks on the road and more inventory being held close to the consumers. And so, you were saying earlier, Zach, about the sort of hump we see a lot of times with Q4 because we move everything forward, for the holiday shopping, and then it's there, right? We load it all up in November, and then it sort of sits there. Well, this year, if it's 50% more e-commerce, it's not going to be, hey, we got to load up the store for Black Friday and then we're done. It's going to be we're continually shipping stuff out, maybe up to only a few days before the holidays, right? And so I think that sort of hump that you normally see where we have the big spike in November is going to sort of be a flatter curve. We might not see as tall of a spike, but it'll go longer, right? So it'll be more of a smooth curve, I think, going later into December than we would normally see.
I see. So more of the same, just extended. I like that.
Yep.
Excellent.
Yep.
Excellent.
Well, it's like the rest of 2020. It's just, it's essentially March 150th right now. So it's just going to keep going in a flat.
March Timbuary, the 3800th.
Exactly.
March was so long. But Mr. Rogers, Zac Rogers, Dr. Rogers, thank you so much for joining us. Zach, we don't have I'm trying to think of something that will be topical for a brain buster because he got our last trivia question.
I didn't even prep. My brain's already spent.
Zac Rogers, Z2. Yeah. What
you guys
is
spent
your
so much
guess?
Time talking before the show about the greatest hip hop hits of 2000. Try to tire yourselves out.
What is your guess of a top 3 coldest state with the temperature ever recorded?
The top 3 coldest state?
Yeah, with the most lowest temperature ever recorded.
I mean, probably, is it Alaska?
You got number 1, Alaska. Okay, all right.
He's blowing it out.
Bush league
is it the
here.
One that touches the North Pole?
Yeah.
Yes. Bush league. Bush league.
I mean, thinking back, you should have said like continental.
Continental, okay. Montana. But
Zach, you're killing it either way. We're gonna have to work harder when you come on.
Hey, awesome. You guys are doing great.
All right, Zach. Thanks again for joining us, and thank you for watching. That'll do it for this week's Freightonomics. Again, thank you again to Anthony Smith,
Zach Strickland, and Zac Rogers.
And we'll see everybody next week. Same bat time, same bat channel. Maybe we'll change it up. I don't know.
Maybe
we can do whatever we want.
We do whatever we want
as long as the video team says it's okay.
Yeah. and George passes on it as well. I mean, you know, a few checks and balances.
We don't have ultimate